What if you found out a company you invested in had signed a financial deal that practically guaranteed you would lose your money? A deal so destructive it has a name straight out of a horror movie on Wall Street, the death spiral. Today, we're breaking down how this predatory financing works, why it's so devastating, and the one phrase you can find in a company's filings to spot it before it's too late. Stay with me. You need to know about convertible debt. In a normal, healthy deal, a company gets a loan. The lender has the option to convert that loan into company stock at a fixed, pre-negotiated price. If the company does well and the stock price rises above that fixed price, the lender converts, gets cheap shares, and sells for a profit. It's a win-win. But a death spiral is a perversion of this. It's a toxic form of convertible debt with one critical, fatal flaw: a floating conversion price. Instead of a fixed price, the lender gets to convert at a massive variable discount to the market price. And this one feature unlocks a financial nightmare. Here's the trap, step by step. Step 1. A struggling microcap company, desperate for cash and out of options, takes a loan from a specialized, some would say predatory lender. Step 2. The contract says the lender can convert the debt into shares at, for example, a 30% discount to the lowest trading price of the stock over the past 10 days. Step 3. The lender converts a chunk of debt, gets a pile of deeply discounted shares, and immediately sells them onto the open market to lock in a risk-free profit. This is pure arbitrage. Step 4. This massive, constant selling pressure drives the stock price down. And now, here's the spiral. Because the stock price is now lower, the floating conversion price automatically resets to an even lower level. This means the next time the lender converts, they get even more shares for the same amount of debt. They dump this even larger number of shares, the price crashes further, and the cycle repeats. The company's stock is caught in a vortex of its own making, spiraling down towards zero. The lender profits on the way down, while every common shareholder gets completely wiped out through catastrophic dilution. So why would any company sign this suicide pact? One word: desperation. This is the financing of absolute last resort. It's for companies that can't get a bank loan, can't do a traditional fundraising, and see this as the only alternative to immediate bankruptcy. And if you're thinking, how is this legal? You've asked the right question. For years, this operated in a gray area, but recently, the SEC has launched a major crackdown with a brilliant new legal strategy. They are charging these lenders with acting as unregistered securities dealers. The SEC's argument is simple. If your entire business model is to provide financing with the sole intent of immediately dumping the converted shares onto the public market for a profit, you are not a long-term investor. You are a dealer, and you must be registered and regulated as one. This strategy is working. In one major case, the SEC alleged a single lender was responsible for converting loans into over 90 billion shares of stock across hundreds of different companies. The scale is almost unimaginable. So how do you protect yourself? You become a financial detective. You go directly to the source, the company's SEC filings. Look for the 8Ks that announce financings and the 10Qs that detail them. You are hunting for specific, terrifying phrases in the fine print. Scan for terms like floating conversion price, variable conversion rate, discount to the market price, and the most dangerous one of all, floorless, meaning there is no bottom to how low the conversion price can go. Your takeaway is this: a death spiral financing deal is not a red flag. It is a full-stop emergency flare signaling a company in terminal distress. For you, the common shareholder, the outcome is near certain financial ruin. The moment you see these terms in a filing, your analysis is over. You sell and you walk away. Don't let your portfolio get caught in the spiral. If you found this breakdown helpful and you want to learn more about spotting dangerous investments, do me a huge favor and hit that like button and subscribe. It really helps the channel. Let me know in the comments what other financial traps you'd like us to expose. This is the Microcap Brief, reminding you to do your own research, read the filings, and invest wisely.